Hi, I'm Mike Whitbeck, one of the managing partners of UberWriter Solutions LLC, and this is our weekly video blog. Well, it's January 2017, and like many years in a row, many of us make resolutions like to lose weight or handle our finances and pay off some debt better, or maybe improve on a relationship. So these are kind of our top candidates for resolutions. But what we don't hear a lot about is business resolutions, like streamlining operations or increasing your customer base. Now, to me, business resolutions are more important than personal resolutions because the business marketplace is such a competitive landscape that you always got to be just evaluating your business and improving your business and looking for any edge you can to make yourself more profitable and productive, and use all the latest technology to get ahead, especially in the mortgage marketplace where the lenders have a lot of different choices to pick from in the mortgage world. And if you're a loan officer out there, you know what I mean, that you're out there battling every day for these loans. Okay, well, hey, good news for 2017. We actually have an advocate in the lending world that wants these same goals for us of reducing operations costs and lending to more borrowers. Now, who is this silent advocate? Well, actually, it's Fannie Mae. And the great news is they're not just out there silently. They've invested in this new system we're going to talk about today that they spent thousands upon thousands, if not hundreds of thousands of dollars, creating and improving the whole mortgage process. Now, this new program is called Fannie Mae Day One Certainty. Now, It basically, I would say it's probably one of the biggest steps I've ever seen on moving the mortgage business forward into a true digital mortgage age. What the biggest component of this day one certainty is that Fannie Mae allows, well, actually I would say prefers, new alternative methods of getting borrowers' income, assets, and appraisals verified, which are much more efficient using new software and some other new technology. No, so how does day one work? Now, the short story is Fannie Mae is basically giving you instant rep and warrants relief. So along with this technology, they're actually giving you relief on reps and warrants for certain parts of certain files. Now, again, it doesn't work on all files. What I mean by reps and warrant is normally that as an underwriter, I would underwrite the file, it would get through closing, and they might audit that file 2 weeks after you sell it to them, or 2 months, or 2 years after they sell it to them. Now, at that point, if you find out they disagree with your income or disagree with your assets or disagree with the value, now you get buybacks, and that costs us a lot of money. With this new day one certainty, before you even sell the loan to Fannie Mae, they're going to guarantee or relieve you of the reps and warrants on certain components when you use the proper software and procedures. Okay, so let's go over what those major components are that they're actually relieving reps and warrants. They're going to help you out with property value using the new enhanced PIW information they put out in October. They're using collateral underwriter to give you greater certainty and direct you at the appraisals they want you to look at more. And certain appraisals like, hey, we're good with the value, just move on. They have an employment validation service using a new employment validation service contract. So, get past the VOEs and finding out people lost their job the day afterwards is a thing of the past. Lenders' income figures can be validated by DU using some of this new technology. And then, of course, lenders' assets and reserves also are validated using a new asset validation service. So over the next few weeks in our blogs, we're going to be going over what these components are and how to use them. So a little bit of backstory. Over the last couple of decades, the mortgage industry suffered from a major meltdown followed by sweeping regulations. This was a 1-2 punch to our operations costs. The loan costs increased dramatically. Lenders today are still fighting to get back to 2008 and 2011, cost per loan for your operations people, your compliance people like that, and it's no easy task. So, lenders need to address 2 major things to reach back to these goals, and day one certainty plays right into these 2 goals that we're about to go over. Now, category 1, I would say, is increase your processing, underwriting, closing per day rate. And what I mean by your per day rate is how many times you can handle it. Now, a number that stands out to me is, as an underwriter, I got in this business in 1994. Now, underwriters at that time were doing 4, 5, 6 files a day with no quality issues, and we weren't working them to death or anything like that. But today's reports are telling us that underwriters are only handling 2 to 3 files, and government files even less than that. So this adds up to more operations costs per loan. Now, this same problem is found in compliance, regulation and post-closing issues. So the bottom line is that the less files that each one of your operations people can touch per day means more cost per day, which means less profitability, higher rates, things that are not good for your business, okay? Category 2 is you want to decrease the number of self-imposed overlays, for borrowers. Now, risk or loan buybacks causes, banks not to want to borrow money, which we get. If you watch the headline, you're going to see that the agencies, there's lawsuits for millions upon millions of dollars suing lenders for selling these agencies supposedly bad loans. Now, each side has their story, and I watch those very carefully. I find them interesting to see how they're handled by each side, the government versus the private industry. But either way, they cost a lot of money, and that's not good for your bottom line either, to lose $1 million in fines. So thus, many lenders will create overlays of files, that basically restrict what they'll borrow, which lowers their customer base. Now, one big category that comes to mind, just as an underwriter, is borrowers that have more than 4 finance properties. There's many lenders, especially in the wholesale world, that will not work with a borrower with 5, 6, 7, 8, 9 properties because either the perceived risk of a buyback or the actual buyback they may have already received because maybe they didn't underwrite them properly or validate their income or assets properly previously. Now, all that means is, less borrowers, less profit, when Fannie Mae would have been happy to buy these loans if you would just follow their rules or use this new validation service. So, the bottom line, look, there's no silver bullet that's going to stop every one of your loans, every loan type from having a buyback or a scratch and dent money. But with this new technology that we have here in 2017, you're going to be able to streamline your operations, and you're going to be able to refocus your underwriting, closing, QC talent to the loans that need attention. For example, loans that don't get the day one certainty exam. So now over the next few weeks, we put out a blog, basically about a blog a week. We're going to go over each one of these components of the day one certainty that we just went over, and we're going to break down what they are, how they work, and that how you can implement certain things to increase efficiency in your team. All right, guys, this is going to be a great 2017. Again, this is a game changer, this new day one certainty, and other agencies are coming out with things like it, and there's all kinds of technology like UberWriter that we built that help play into this new digital mortgage age that'll make you even more efficient, reduce your operation costs, and get you to a great year. All right, thanks for watching, and we're going to catch you on the next blog. Have a great day.